At this point, I'm sure everyone knows exactly how leverage decay works and that it's far more significant for inverse leveraged ETFs due to the simple math of percentages. If the underlying does as follows, it equals a 10% rally and a roughly 9% drop, which equates to a plus or minus 30% move and then a plus or minus 27% move, depending on whether we're looking at a long or inverse leveraged ETF, which of course is a little bit bad for long leveraged ETFs and utterly terrible for inverse leveraged ETFs, because in that case you'd be going from 100 to 70 up to like 87. The main arguments people have on behalf of their use, despite hearing this information, is that they're only meant for short-term use and that these ETFs largely came about after real crashes. We didn't have minus 3x ETFs during 2000 or 2008. We've only had them exist in bull markets. So how can we compare them and their use cases when we haven't really seen what they're meant for, which is, of course, hedging for a large drawdown, which is, of course, correct. The early versions of these, SQQQ, for instance, came out in March of 2010, just after the great financial crisis, but certainly not preceding it. So what we're going to do today is look at how these things performed prior to their inception in March of 2010. I have a system set up here that can do that for us. We're going to do this without annual fees, just to stay a bit optimistic, so that when things still look bad, we can say that they are in fact worse than that. And we're going to do this throughout the entirety of the history of the Dow in this case. So let's start with the Dow in 2008, and let's flip our leverage ratios to be negative. You can see what color is represented in the legend on the left, and what we're covering here is the main decline during the great financial crisis. Everything starts indexed to 1000, and we can see that at the low here, from start to end, the decline was greater than 50% at one point during this period. And at this absolute market low, the 3 times inverse ETF would have been at 2700, the 2x 2400, and the 1x at 1700. And then let's move a bit further to the end of the timeline and see that at this point, the negative 3x and the negative 2x are either down or flat, and the negative 1x is still up a bit, despite the base index itself being down around 30%. You might think this is good, but I'm going to tell you why this is incredibly poor. My main reasons are that this is an assumption of perfection, entering, of course, at the market high itself and exiting at the low, and even in that case, the performance, not as great as you'd expect given the risk that you're taking. 2, still worse than options. If you had bought leaps for a year or 2 out, they would have performed better percentage-wise, especially out of the money options. So if you are hedging a crash, those still seem far better. Next up is that they're certainly worse than futures, who provide not only more margin, no decay, and even interest rate-based contango, all of which are in your favor here in relation to inverse leveraged ETFs. But not only that, both index options and futures are taxed better than inverse leveraged ETFs. Yes, you might be in a cash-only account, something like that. In that case, generally, there's a good chance you can still trade options. If you can't, you likely shouldn't be shorting in that type of account. That's not really what those are for. Back to this example, what happens if we start just a bit earlier and we assume, hey, we don't nail the market top perfectly. We don't get within 5% of the top. What happens in the case that we enter a bit earlier? Instead of going from 1000 to 2800, we get up to just 1700. And you could argue that options would do poorly as well, especially into the top, which you would be absolutely correct in saying, but the negative 3x ETF would have also gone all the way down to 500, a 50% drawdown from the start of this position until the top, similar to what you would see in options-based hedging situations. And of course, almost immediately after the low, due to, as we explained, volatility decay, these things go from being up to down almost immediately. For instance, in March of 2009, while the 1x ETF is still down over 30% from our starting point, the minus 3x is also down, far from ideal. Now, what if you're a true perma-bear and you think that we're heading for a Great Depression style crash? Of course, these things would do incredibly well, but my prior arguments stand that if that's what you're trying to hedge, do you really think you won't find far greater risk-reward ratios in 50% out of the money options? Or in this case, greater percentage out of money options than that? But let's still look at this situation. Let's assume that we start at the exact market top, in this case looking at a linear chart just because the returns in this case would be quite incredible. Your initial $1,000 investment into SDAO in this case would have been worth about $26,000 at the market low before quickly and almost immediately losing everything on the first bounce following the Dow's low at this time. But for a moment there, you would have been up around 2,600%. And if we look at this on a log scale, you'd be back underperforming the market by July of 1933. But of course, you don't intend to hold it across that entire time period. This perhaps is the one case scenario across all market history in which case it actually would have been worth it. Though, are you really meaning to tell me that you have been able to sit through all that volatility? I doubt it, but maybe you're so convicted in your bear stance that you would have been able to. Interestingly, despite 3x obviously being the best performer by a significant amount, for the leverage and volatility you're experiencing, I would say in this case, 2x is probably your best bet, as it is in general, as I've discussed on the long side as well. The 2x is generally the best leverage ratio for most situations. So if you feel the absolute necessity to do this stuff, I would say do it in negative 2x, not 3. But in looking at a long-term chart, you can obviously see the position you're taking. Looking at a situation like 2000, for instance, is a perfect example of why these things are poor, especially with higher leverage ratios, being that the Dow was still down about 15% across this period, but the inverse leveraged ETF, 3x in this case, was down about 50%, and the other ones also down a bit, aside from negative 1x, which experiences the least decay, obviously. And once again, the point isn't to say that returns can be positive, it's just to say that positive returns are easier to come by elsewhere, and there are far better ways to hedge. Additionally, if your argument is that they are really only used for one-day cases, you're better off with futures, or perhaps even ODTEs, vertical spreads, something like that, because why wouldn't you just trade futures and get even more margin and likely better tax treatment? So in conclusion, generally speaking, obviously, shorting in general doesn't have much benefit, shorting with leverage has less benefit, and shorting with leverage and leverage decay has even less than that. That's what you get with inverse leverage ETFs, and generally, I think you should avoid them. Thank you for watching, like, subscribe, that's about it.